Hey traders, Nick here looking at Apple. Inside the macro that the sellers are no longer in control and that the buyers are back somewhat in control, assuming that there's no new shoe to drop and assuming that we will get a fix to the China debacle as far as trade is concerned. Okay, so Apple is obviously a mega cap and one of the largest companies on the planet. I think they swap spots with Microsoft and Amazon. But anyway, so I'm not a fan of Tim Cook, and you probably already know that. I don't mind the company itself. The fundamentals obviously are solid, but Tim Cook has had a gem on his hand and he's done nothing with it. He gets a lot of kudos on Wall Street from a lot of people in the media, on CNBC, but I bet you anything that the company would have done just as well, if not a little better, without a CEO altogether, completely without a CEO. I don't remember anything new coming out that wasn't in the works from Steve Jobs' times. So fundamentally, it's a boulder that's running, and if it stops, I don't know if he can push it back up to start it over again. Meaning that he better find a new wow factor soon, and I don't think he's the right guy. Maybe he will prove me wrong. Nevertheless, here we are. Stage is set. We have earnings coming soon. We are about 30% off the highs. We are in a similar situation to last February when they reported earnings, which is around here, February 2nd, and it bottomed on the 8th, 9th, which is when I thought we had hit the bottom, and indeed we had in the market in general. So luckily, their earnings came at the end of it, and all the froth had come out. So here, the plus is all the froth has come out. The easy short is done. From here to short it, you're going to need bad news. What does that mean? So we've had trickling news from Taiwan Semiconductor, for example, and other suppliers and other hints that indeed things are slowing down for Apple and repricing this and repricing that and cutting production here and jobs there. So Tim Cook recently came out and said they dropped a bombshell about forecasts and the stock collapsed, whatever it was, in one day, 10%, 12%, whatever. So the easy money is out. From here, you're cutting into bone, so to speak. And for that to get worse, you're going to have to miss the new lowered expectations. So now all the expectations are lower. The bad news, if it comes out in the earnings soon, it will have to be really bad for it to go as far as before. So that leaves the upside surprise. Onus is on Tim Cook to surprise people like me, doubters like me, what's going to go on. So if I own the stock, it's probably too late to get out of it now. If I'm looking to buy the stock, I'll probably buy it in chunks. Meaning if I'm thinking about buying 200 shares, I'll buy 100 and see what happens after the earnings. Or I sit out the earnings. But the earnings, the short-term reaction to earnings is always a coin flip. Always a coin flip. Even if they hand us the P&L, we don't know what to do with it. We don't know how the market's going to react. We don't know what he's going to say in the call or anything. So let's put that to the test. This is a drop on earnings. This is a rise on earnings. This is a rise on earnings. This is a drop on earnings. So we've had 2 and 2. That's 50%. I can argue that point with anybody for hours. Some people will never believe me, but it's always a coin flip for the short term. Short term. Okay, so I could buy the stocks here, Apple, and sit on it. If I'm long Apple, I'm not getting out. And if I want to go long Apple, there are ways to do it with the options market. So if I want to go long Apple now and I don't want to commit the full price for the stock, I can buy calls, which locks in my price. And usually there are two ways of doing that. You can do it for the long term and say, okay, I want to commit for a long term and buy a leap that expires next year. Those are expensive, but less expensive than buying the shares. And the advantage of doing that is that then you lock in your price for a long period of time. They're expensive. So if let's say, okay, I want to buy the shares at $165, and you buy the call at $165 for next year. So you have a contract that somebody says, I will sell you those shares at $165, even if Apple is at $350. They take in money from you right now. And for that risk, they commit to giving you the shares at 165. So they're on the hook for losses above that. You have the privilege to say, okay, I want to exercise my calls. If you see Apple at 200 and say, you know what, I own that ticket, give me my shares at 165, so immediately make the difference minus what you paid for that call. Sometimes you don't even buy the shares because that call becomes so overheated in price then, because let's say you bought it for $10 and now it's $40 or $50 or $60. Believe me, the percentage move in the call or the put premiums, whichever way you prime, is hundreds of times more than the stock itself. So on any day, if you see a stock moving 2-3%, the options are 200, 300, 800%, depends on where you buy them and what kind of a stock it is. The bang for the buck is much bigger, huge difference, and it's a fact, it's not an opinion. But you have to guess the direction correctly. So if you guess wrong and you own the stock, if you bet upside and you buy the stock, then and you guess wrong for the first few weeks and the stock dips, the calls get hurt a lot more than actually owning the stock. That's the downside. But if you guess correctly, if you guess up and it goes up, if you guess down and it goes down, you're making hundreds of times more money percentage basis between stocks and options. The options are a bigger bang for the buck. Having said that, there are ways, I will lay them out, but I wanted to give the concept. So what's the other way? The other way is to sell risk and commit to a downside scenario. I'm going to flip to a 5-year contract. Not contract. What's on your mind? 5-year chart. So every candle is 1 week. Gives us about 5 years worth of action, and to split the action here with a crayon. Sorry for all the lines, but I'll clear it up. I just want to see just the levels. In fact, let me see. Maybe I can declutter a little bit. I go to monthly candles. All right, monthly candles. That's concept is better that way. All right, there we go. This is Apple. Period of time 2013, 2012 and on, and that's the big drop that we just saw. And if I eyeball it, we have this move over here about halfway. So they're going to fight over it. This was the recent low. This is where we're at right now. This is monthly. Every candle is 1 month, so it has not had a good couple of months. In fact, those are the 2 worst months I've seen in a long time. If I'm looking here, there's no candle that size. The stock market in general has had its tizzy too, but some of it is self-inflicted in Apple. I also can see that this here was resistance at some point, 2015. And then right here, they decided, nope, they want to break out. And since then, it has not been tested, and we are close. So it remains to be seen if prior resistance becomes forward support. So this is the point of keeping track of prior action, because markets have memory. People say they don't have memory. They're wrong. Market have memory, and I can prove it on any time frame you want. But nevertheless, this is what we have right here. We have several levels that we're looking at. Back to the point, when I sell a put, what happens? What is a put? It's a contract. What is a call? We just talked about a call. It's a contract that gives me the right, if I buy it, to be long the stock at X level that I choose. And if price goes above it, I have the right to buy it at that price. I'm not obligated to do it. I have the right to do it. So the opposite is committing to buying the stock at some point if it falls. So let's say somebody out there owns shares of Apple and is afraid to be below 100 or below 120. And let's say I do my homework and I say, you know what, at 120 it's a bargain, I want to buy it. So I sell a $120 put. I'll go out to these people and say, don't worry about it. If it falls below 120, I'll buy it off of you for 120. They say, okay, great. So they pay the premium. What is the premium? It's like an insurance policy. They give me money now, and the prices for those premiums are preset in the table, so nobody's guessing, nobody's screwing anybody. It's just these are the prices. I say, I'll buy it. I'll sell it. Here you go. Here's your ticket. If Apple goes below 120, I'm a buyer at 120. If it falls to 110, I'm on the hook for $10. So that's what selling a put is. I commit to buying the shares. So worst case scenario, I end up buying Apple shares at $20 or $30, $35 cheaper than current price. Not the end of the world, right? How much is that premium? That premium changes by level, how far away from reality, this is reality, and by time, how far out in time. Why? Because think about having a lottery ticket that there's a drawing on Wednesday and then that's it. What about a lottery ticket that you can watch every week? And there's a whole bunch of time for it to come due. And you can play it every week, same ticket. It's more expensive, right? So there's more time for things to go wrong and right. Therefore, there's a premium for the seller and the buyer. It depends on what we're doing. In this case, I'm just going to give you an example. I'm trying to look on a different screen. So January of next year on Apple. So if I wanted to go out there, it's got about a year. If I wanted to sell a put at 120, somebody will have to pay me $4-ish. And for that, money goes into my bank, my account. It's not mine because it's a liability. I don't have the money to play around with it, but it's in my account. And if there's no accident, I don't pay the insurance, correct? So if Apple stays above 120, then it's mine. Or if I buy it back, because I have the right to buy it back at any point. You know what? I changed my mind. Here's your ticket. Give me my money back. So I can, here's your money. Give me the ticket. The deal's off. That's one way of actually going along Apple without any out-of-pocket expense. The only risk is downside. If it falls below the price I commit, then I have to pay money. Now, I'm not doing this video to specify that this is a good idea. If what I said about Tim Cook is correct, this might not hold. I'm not saying it's going there. I'm just saying that's probably not where I would want to sell it personally. At 100, it'll be cheaper. At 115, it'll be $3. So that gives me $5 extra worth of buffer from current price. Buffer meaning current price is here, risk is here. I want as big a buffer as possible while it still makes sense. So where's my break-even point? If I sold the 120 and I collected $4 for round number's sake, then my break-even point is $4 below the 120, so 116. Anything below 116, I'm losing money because I collected $4. They gave me the stock at 120. I had to pay for it at 120, but I have $4 to play with. So now if it goes to 116, I'm even. If it goes to 115, I lost $1 per share. Anything below 116 will be my loss per share. Compare that with having been long buying Apple shares from 155. So big difference. I'm building a buffer. I'm collecting money for it, all for the privilege of owning the shares at 120. Now, this concept does not work with every stock. I would not do this with anything frothy. What does that mean? Somebody that is not, any pot stocks, for example. Tilray. Okay, perfect example. That's the other extreme. So Tilray, I'm going to go to the daily chart because they're a new issue, is a violent stock that is so expensive that I wouldn't want to commit to buying the share at any point because it could go to zero. I'm not saying it is, but it could go to zero more realistically than Apple. They have $20 million in sales, $22 million in sales, and their market cap is probably $6 billion. Yeah, billion with a B. So it is a stretch, and I would not want to sell puts or calls. Definitely no selling calls. Selling calls is like shorting a stock. Unlimited losses. As long as the stock is running, you're losing money. I wouldn't want to sell puts in this guy. I have before, but it was for like a period of time that I knew it was a short period of time and a bet, and I was ready to own it just as a fast trade, but I would not do it through earnings or anything like that. So the idea is that using options to lower my dollars at risk. If I buy options, then I'm lowering my dollar at risk for sure because I'm paying a lot less than owning 100 shares, for example. If I'm selling options, I'm definitely lowering my dollars at risk because I'm not spending anything out of pocket right now. I'm committing to X or Y. So if I sell a put, I'm committing to buying it, but I don't need to buy it right now. I may not ever have to buy it. So what about Apple? Apple has a problem. So short term, earnings are coming. And this is a daily chart. So we have an accident scene right here. I'm going to eyeball it at 160. So what happens when we get there? We've talked about this. That's the major accident scene that recently happened. People that got stuck here may want to be whole. Why would there be people stuck? Because that would have been a trigger. You see lower highs, higher lows, coming to a pinpoint. A lot of momentum traders, they buy the calls or buy the stock anticipating a bust because the market is moving. And then they come out with bad news. Rug pull. They've worked their way back out of it. That's really good right here. Higher low, attacking a neckline. So there'll be a battle here. It might do this. It depends on what the earnings say. It might just break through and follow the whole market. So level 1 is 160. 165 is another eyeball level. That's going to be important. Every ledge is important. 171, 172, I'm going to eyeball it. And, 175, 6. This, the major ledge right here. 182 and change, 185. This is a major accident scene right here. That tick fell apart, came to it. They had the opportunity to combat it, and then, and if I look left, something happened here. So time to zoom out. Look at that. It matches up to another blue box. These boxes are zones. They're not hard lines in the sand. But if I do this and expand it, 280 probably will get us there. So it's an area of, it's a battle zone. So they're going to fight it out over here, and that happens to be a lot of volume happened here. So prior action, whoever fought over it here, they're going to fight over it again. As I zoom in, my volume changes accordingly. So this tells me that there's going to be resistance in this area. The only way they break through an area without paying any attention to resistance is if the earnings were inflammatory one way or another. Really good news or really bad news. Then they break through resistance or support and they don't care on an event. But if there's just normal price action, I would anticipate a lot of resistance here and a lot of resistance there. So there are a lot of areas where the bulls, onus is on the bulls to prove that they can do it. Like 159.24 is one. That's where I have a trigger. If I see movement above that number, then I anticipate more buying, inviting more buying. Here's another one, 162.10. Another one is 167, 70, 70, 80, something like that. And then 172, let's call it, to, you can argue this whole zone is going to be important. So this is the problem with the Apple conundrum here. Great company in the hands of maybe a good person leading it, I'm not sure, but I know one thing. If it was in the hands of Bezos or somebody like the CRM CEO, it would not be as boring. One thing Tim Cook did, he buried it in debt. What? You're screaming at me. Yeah. When he took it over, it has zero debt, long-term debt, zero. Now it has over 100 billion, 120, I don't know, I lost track. The rate of debt increase was insane. If he was getting in debt to buy companies, that would be one thing. But he got all the debt in order to pay dividend and repurchase stock. As long as the company is performing at a higher rate than the increase in whatever he's paying out, then that's a good idea. Otherwise, what's the point? But people say, well, it has a lot of cash. Well, if my house has a lot of value, that's not a reason for me to bury it in mortgage after mortgage after mortgage. Yeah, they can afford to service their debt. I'm not worried about that. But I'm worried about the decision-making process to take on $100 billion in debt and more in such a short period of time and do nothing with it. Amazon bought Whole Foods. What does that mean? It means that now they have a footprint in the ground. It means that they've been dating with all of their clients online and now they met and it's not a catfish situation. So they love each other even on the ground. So that's what I'm saying, the difference of leadership. One person is not showing any innovation. When management has to explain where the innovation is, it's not obvious that there is an innovation. Nobody told us where the iPhone innovation was. It hit us in the face. Same with the music, iPod before it. It hit us in the face. Wow. You know, people loved it. The people loved the idea of it. This time they're trying to tell us where the innovation is. Like, okay, if you say so, that's innovative. New colors, new pricing structure. You know, the iWatch tracks this or that. I don't know. I'm underwhelmed with the innovation. And then what worries me is when the CEO tells us they've never been better. All at the same time when everybody's doubting it. When the CEO tells me they've never been better, at the same time when everybody is worried about it, they either have an outstanding surprise coming or they're full of it. You know, he's starting to remind me of the IBM CEO, Jenny Rimetti. I think that's her name. So she is, I can't believe she still has her job. Totally nice person, sounds great, only is just a bunch of hogwash. The price now is the same as it was in 1999. Whereas if I put Amazon in here, that's Amazon 1999 and Amazon now. I don't care how they did it, small margins or whatever, they did it. This is Apple, equally impressive. Where did he take over? I can't remember, 2014? So the stock did well, but my argument is that it would do this well without a CEO. Anyway, back to the point. I'm afraid to be long big time through the earnings. I would rather bet on the QQQ. Apple is a huge mathematical part of the Qs, and actually all the indices. But if I wanted to bet, just like I did with the Netflix, and it turned out to be a winning strategy. Instead of betting on the Netflix earnings, I bet on the market, the tech market, basically the NASDAQ, the Qs, and that paid pretty well because we had a big rally. Netflix lagged a little bit. So I think I will use the same strategy for myself. However, I will share all the setups that are available for the trade on the Apple, and it's up to the individual to take the risk wherever they want based on tolerances and personal portfolio balance. Okay. So if you have any questions, this is a long video, but it's a big company, and that's pretty important.